Hello everyone, I'm Oscar from Sinopac Securities. Sinopac Securities is a leading broker in Taiwan for global trading assets. And our success would not have been possible without strong partners like nasdaq, which enable us to provide investors in Taiwan with convenient and seamless access to the global markets. Today, we are truly honored to have nasdaq Chief Economist Phil Mackintosh with us. Phil brings deep insights into market structure, trading behavior, and broader economic trends. Phil, it's a pleasure to have you here. Would you like to say a quick hello to our audience?
Hello everyone, I'm NASDAQ's Chief Economist Phil Mackintosh, and I'm excited to be here.
Thank you, Phil. To start it off, I would like to take a step back and look at a bigger picture. In recent years, we have seen a trend of reshoring and rising trade barriers. How do you view this structural change? What kinds of impact are they having on sector performance and trading behavior?
Yeah, I mean, this is really a lot of what I've been talking about for the last 6 or 8 months. It's all about tariffs. And what's interesting about the tariff, debate that's happening right now in America is we can go back to 2018 when Trump was president the first time, and we have a little case study in what happens with tariffs and trade. So remember in 2018, Trump put tariffs really just on China. When he did that, Chinese exports made up more than 20% of all American imports. Since those tariffs, China's percentage of US imports has halved. But what's really interesting is a lot of countries have become winners out of that. The region I'm in right now, the Southeast Asian region, a lot of countries are now exporting more to the US to replace some of those China exports. A lot of European companies are exporting more, Mexican companies were winners, even Canadian companies are winners. So putting this in context of what's happening right now with the new administration, Trump with his second presidency, we've got more tariffs, more broad tariffs, but it's still going to be the same kind of outcome. There are going to be some companies and some countries that are going to be beneficial and winners of the tariff war because they have relatively low tariff rates, and they might see their sales expand. And countries and companies that have high tariff rates should actually struggle to keep selling as many products as they were. And so what you'll see is a rebalancing of trade, and it might end up tilting into some of the countries with lower tariff rates doing more exports. Of course, the objective of the administration is actually to also get some more onshoring, some more manufacturing in America. And one of the reasons that they really want to do that is America runs a big trade deficit, which means we buy way more from overseas than we export to overseas. And we want to try and manufacture more in America and create more manufacturing jobs in America. That, in a nutshell, is the reason for the tariff war.
Of course, many of these structural shifts also tie back to the broader inflation environment. When inflation expectations change, how is that typically reflected in ETF flows and cross-asset trading patterns? Are there clear signals that investors are reallocating their strategies?
Yeah, I mean, ETFs are one of the really cool products for investors to be able to trade thematics or macro events very quickly and very easily. Obviously, you could buy an ETF on Asia, you could buy an ETF on metal producers, you could buy an ETF on bonds, on foreign bonds relatively quickly and relatively simply. So ETFs are one of those places where you see really smart hedge funds and a lot of retail allocating assets. In reality, so far this year, because the tariff war has been a bit of a stop-start affair with some extensions and some negotiations, and we've got to the point where we may have some certainty in the last couple of weeks, the flows in ETFs haven't been that significant in terms of what the tariff's doing to the flows. I think a lot of people are still sitting on the sidelines a little bit. Having said that, there's some segments of the global economy that are doing really well. In Europe, the defense industry suddenly realized that it may have to start looking after itself, and Europe is talking about deregulating, investing in its own defense sector, and so the defense stocks in Europe have been going great because a lot of people are starting to buy them. So you can see some asset allocations because of what's going on globally and geopolitically with the tariff war, and you can see some flows in ETFs, but I expect once we get some certainty on the tariff war, you'll see even more ETF flows.
And those shifts in investor strategy often showed up in how hot the market feels and how stretched valuation become. Lately, there's been a lot of discussion about whether markets are overvalued, maybe even overheated. What indicators do you look at to assess whether sentiment is outpacing fundamentals? Things like retail activity, trading volumes, or valuation spreads?
Yeah, it's a really interesting and kind of complicated question. And I think the first thing you've got to do is break down which markets have been rallying a lot and which ones haven't. Because the markets that have rallied a lot are the ones that people are talking about maybe being overheated. And really the market that's rallied the most is something like the NASDAQ 100 market, which is the 100 largest stocks on the NASDAQ. It includes the MAG 7 stocks, it includes a lot of tech stocks, but really importantly, it includes a lot of the stocks, if you want to play artificial intelligence, that are earning real revenues from artificial intelligence. So although we're seeing price earnings multiples going up, we're also seeing earnings kind of keep up so far. This is quite different to what happened in the 1990s tech bubble, where a lot of the tech companies didn't have earnings at all and were burning through cash. What we're actually seeing with a lot of the AI complex is there is real revenues driving the earnings. The PE multiples go up, but then earnings catch up to the PE multiples. So the stock market's kind of doing what the stock market does best, which is looking forward at which companies are going to be winners out of the current dynamics in the economy. And really what's driving the economy, at least what's driving the stock markets, isn't the economy, it's spending on artificial intelligence at the moment, which is actually real revenues. So the valuations, I guess, are priced for that to continue. So it's up to all of us as investors to assess, like, how much longer will we keep spending on artificial intelligence? How long until we start to think about the companies that are going to use artificial intelligence to become more productive and increase their profit margins too?
Look at today's market environment. It's interesting that equity keeps rising even though the economy data remains somewhat mixed. In your view, what's really driving stock prices higher right now? Is it strong corporate earnings, passive flows, liquidity, or something else?
Yeah, what's driving stock market earnings is actually mostly the spending in AI, so it's earnings. And if you look at a lot of indexes over extended, like decades of time, earnings go up and stock prices go up. Most of what you're actually buying when you buy a stock is a share of the future earnings and earnings growth of that basket or of that company. But the other things that are tailwinds for stocks at the moment, a lot of the countries in the world have tackled inflation since COVID, and so interest rates are coming down. And when interest rates come down, interest expense comes down, so that helps companies be more profitable. We've also seen a lot of countries with wages going up, and actually going up faster than inflation now that inflation's under control. And so consumers have actually got a fair bit of extra spending power, and they've been buying things. So of course, if you're a company and you're selling products and the consumers want to buy more, that's more revenue, more sales. And so we've got some tailwinds from the consumer, and we've got some tailwinds from interest rates, as well as this sort of overarching shift in the economy, spending on artificial intelligence and driving the earnings in that complex of the market even stronger.
Beyond developed markets, many investors are also paying close attention to emerging markets. Volatility tends to run higher in emerging markets compared to the developed ones. From a market structure perspective, what factors, such as liquidity, investor composition, or trading infrastructure, do you think explain this difference?
Yeah, I mean, theoretically, having a lot more buyers and sellers stops the market from going up and down as quickly, and that is essence of what volatility is, like when stocks go up and down. And it can be caused by supply or demand, so one big buyer makes the stock prices all go up, and that looks like volatility. But emerging markets are smaller companies with more concentrated business models, so sometimes they get more affected by the macroeconomic news than big conglomerates in some of the developed countries as well. The good news, I guess, for emerging markets is often the cost of labor is lower, the opportunities to be more productive are higher, and so in theory the growth rate should be much higher as well. And so emerging markets have often been looked at as a potential growth engine for buying stocks. The trouble is you've got to be careful of interest rates and just the overall macro environment for each of those countries to make sure that they're stable enough for the companies in the markets to grow profits as well.
And finally, I would like to shift back to investor behavior, especially during market downturns. We often see buyers step in when markets are falling. Based on the data, who are these buyers, and what does market structure or sentiment data tell us about their behavior?
Yeah, it's one of the things that in the US right now we keep hearing in the press is we're just buying dips. And so the market goes up and up and up, and then when it starts to go down, you get a whole lot of extra people buying the dips. I think the reason that people are buying the dips is partly because they've got more wealth, because their wages have gone up, but also because they know that the earnings are starting to increase and interest rates are coming down. It's all those tailwinds we talked about. In terms of who buys the dips, often it's quite a lot of retail investors. Retail are not as skittish as I think professional investors think. They're quite good at picking discount opportunities to get into the market and sort of dollar cost averaging into their investments. But it's also a lot of people with fundamental views that are looking at the performance of companies. And so when everything gets a bit cheaper, there's a point where it's attractive to become a buyer.
Since we have touched on sentiment and behavior, I would like to close with a metric that often makes headlines: volatility. Volatility indicators like the VIX dominate the news cycle, but how useful are they in forecasting long-term returns? Historically, we can learn about the relationship between short-term fear and long-term performance.
Yeah, if only we all knew how that worked. The volatility index, or any measures of volatility, tend to spike when things start to get bad. And when things start to get bad, because stock markets are forward-looking, prices tend to fall at the same time as volatility spikes. And the risk is that just because the volatility is spiked doesn't mean it's the instant of buying opportunity. Sometimes volatility can spike for a month, sometimes it can spike and come back down in a day. And so understanding what's causing the volatility to spike, understanding when investors will start to, become less stressed about the bad news and start to focus on the longer term performance of the companies in the indexes is important. So the volatility index itself is a signal that the market might be becoming risk off and there's more sellers than buyers, but there's usually bad news with it. So the trick for investors is to maybe use that as a starting point to look for chances to buy dips, but also understand the macroeconomics, understand why there's sellers out there, and look forward to where the places are to be buying.
Thank you, Phil, for joining us today and sharing insightful perspectives.
Thank you for having me. It's a pleasure for NASDAQ to coordinate with Sinopac, and I really hope that we've been able to help Taiwanese investors understand the global economy better and become better investors.
Thank you all for watching. I'm Oscar, and I look forward to seeing you next time.